MPW shares are crashing in the pre-market now, $3.88, down 22%. 2013, they had a horrific year, down 59%. 2024 does not look any better. They are now into the $3. In today's episode, we're going to understand what is happening with Medical Properties Trust. We're going to analyze their dividend safety, look at some important financial metrics of this company. We're going to jump into the valuation. What is our updated intrinsic value calculation? What is our acceptable buy given our investor margin of safety? We're also going to take a look at the company's financials, look at their income statement based on their latest earnings, their top line revenue, as well as their bottom line net income growth. We'll look at the health of the company, their total cash versus their total debt. And we'll also analyze the industry as a whole. Is this a performance that MPW are having in isolation, or is it a collective in the industry? And we'll also analyze a statement that they did bring out just yesterday after the market close. And as always, we'll analyze what the institutions are doing. Are they still buying, or are they looking to sell? Now, yes, they had a horrific year, 2013 down 59%. 2014 does not look any better for this company, down 23% in the pre-market, $3.87 currently from $5 when market closed. We can see this will now be the new 52-week low when the market opens. They do currently offer a yield of 12%. I do envision a dividend cut coming imminently, and we'll discuss that further on. We see the forward P to AFFO sitting at 319 with a significant short interest at 25.5%. Now, if you've been holding this company over the last 10 years, you would effectively be down around 61% in your position, and we do see the all-time high towards the beginning of 2022 at $24. So let's take a quick look at the financial statements, jumping in with the income statement. What we like to see for REITs, 5 to 10% growth year on year. 800 million in 2018, 1.6 billion in 2022. So they have doubled their top line over the last 5 years, which is a positive sign. We can also see they have increased year on year. Again, very nice to see as an investor. But do note, based on the trailing 12 months, their December 23 figure is expected to be lower than 2022. And as always, do hit that subscribe and bell button so you are notified when we do run through MPW's latest earnings. How does the bottom line net income compare? What story can we see here? Well, 1 billion reported in 2018, 900 million in 2022. So whilst the top line revenue has increased, their bottom line net income has gone the other way. And on top of that, to add fuel to the fire, 2023 is expected to be a net loss of 33 million. So it isn't looking good so far based on that bottom line, but let's try and dig a bit deeper. Balance sheet, total cash versus total debt. 821 million worth of cash in December 2018. Latest quarterly report, 340 million. So we do see their cash position has reduced over the last 5 years. It isn't necessarily a bad sign, but let's compare that to their total debt, see where that has gone. 4 billion as we see in 2018. Latest quarterly report at 10.2 billion. So let's have a quick look and see what the industry as a whole has performed. Healthcare REITs, we have Physicians Realty Trust, Care Trust, and a few well-known others. Now, 2013 MPW down around 53%, even after those dividends reinvested. We can see the worst performing, and we do see, in fact, 3 of the others peers having a positive return. So it isn't an industry-wide effect. It is something that is in isolation to MPW, as we see they had a horrific 2023. Now, when we look at the last 5 years total return, we also see they had performed very poorly, down 55%. But overall, the majority of companies have returned a positive performance. So a bit to take in there, just understand that past performance isn't an indicator for the future, but so far it isn't looking too pretty for Medical Properties Trust. Now, before we jump into the dividend safety, we can take a quick look at the article they did publish just yesterday. And they've essentially provided an update on Steward Healthcare. So who are Steward Healthcare? They're essentially one of the tenants of MPW. And we can effectively see here that this article is stating that MPW announced their plans to accelerate their efforts to recover uncollected rents and outstanding loan obligations from STHCS. Now, let's take a look and see what the figure is. So it is approximately 50 million as of the end of December 2023. They do still make partial monthly rent payments and unrent rates consolidated, but do understand that that 50 million is around 60% of their Q3 total revenue. So in terms of what the institutions are doing, we still see quite a high institutional ownership sitting at 76%. In terms of outflows, inflows were around 830 million worth of shares were sold over the last 12 months. Around 1.3 billion were bought during the same period. So over the last 12 months, institutions have been buying more shares, and we can note in Q1, we see more outflows depicted by the red, more inflows significantly in Q2, a little bit more in Q3, and we wait to see the final figures for Q4. Now, in terms of the dividend safety sitting at 20, very unsafe. We will take a look at the financial metrics that support this, but we can see it is very likely that the 12% dividend yield is going to be cut very soon. In my opinion, it is a matter of when and not if. Market cap, then, it is a 3 billion market cap company, mid cap in fact, and when we take a look at those recessionary metrics, they cut the dividend during the 07-09 recession, -5%, so remember above average growth, which was around -12%, but they severely underperformed the S&P with a -76 versus the S&P's -55. Now, dividend growth, we did see a dividend cut last year of 48%. Although on average over the last 5 years, if you have been holding, you would have got around 4%. Last 10 years, again, 4% in line with inflation. And it should come as no surprise, given their dividend cut, they've had 0 years of dividend growth. Now, in terms of dividend yield theory, yes, it states a company is undervalued when the current yield sits above the 5-year average. So we see a sign of undervaluation here. But as always, we don't look at any of these in isolation and draw conclusions towards the end. And even though dividend yield theory shows us a sign of undervaluation, based on the information, I do believe we will come to a different conclusion. Forward P to FFO ratio 4.5, sitting below the 5-year average of 14.4. So this is typically another sign of undervaluation. And we see the sector P to FO significantly lower than real estate at 14.1. Now, when we take a look at the free cash flow, it is what we typically look at. However, for REITs, given the volatility, we do focus on the adjusted FFO funds from operation. Below 95% is what we target. 2022 at 82% is fairly positive. 2023 at 76%, again, very positive to see. Now, let's focus on the adjusted funds from operation. 93 cents in 2013, 142 in 2022. It has increased, but two things to note: the inconsistencies, where it does increase then decrease, remains fairly flat over the period. And we can see in 2022 to 2023 we are expecting a drop and another significant drop in 2024, so this is expected to come down quite significantly. Sales growth then 5 to 10% is what we expect for REITs year on year, so it is positive to note we have seen that for the large part of the period. However, 2022 at only a 1% increase, 2023 at a -12%, it does give some cause for concern. Total sales numerically then, well, they've managed to increase it from 250 million in 2013 to 1.58 in 2022, and do also note that drop in 2023. Now, shares outstanding, 153 million in 2013, 599 in 2022. We can see something that is extremely typical with REITs. They do dilute your position as a shareholder. The reason for this is they're issuing equity to fund property acquisitions, as they retain a little of that internally generated cash flow after paying dividends. But some REITs will dilute your position faster than others. Do check some of the REITs we have reviewed on the channel if you want to compare. ROIC, typically 10% or more for the majority of companies. For REITs, around 3 to 5%. Gives us faith management are effectively able to allocate their capital. We can see the last 3 years, in fact, higher than 5% in 2022, although note it is expected to come down to 3% in 2023. Operating margin, nice to see the consistencies around 60%, but again, we do see a drop in 2023, which gives us some cause for concern, given how consistent it was, that we may be seeing a further drop in the operating margin over the next few years. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us two things: the dividend strength and essential balance sheet strength as well. Now 2022, 7.54, this is the number of years it takes the company to pay off all of their debt net of cash on hand. It is above the 6, but the worrying thing is in 2023 it's expected to go higher, 2024 even higher, and when you consider that versus the unpaid amount of rent that they are due to collect, it does seem very likely that a dividend cut will be coming. The dividend score sits at 20 at the moment, very unsafe, and we did see a higher dividend safety score at about 30 to 40 for Walgreens, which also had their dividend cut yesterday. So something to think about, and if you do want to check out Walgreens review, do go have a look on the channel. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or watch list, do click on that pinned comment below. Now we can start off with Graham's valuation. This is the first model that we use, but as always for REITs it isn't essentially appropriate, so we will move on to the first one for today, which is the REITs multiple valuation model. Companies in a similar sector and size, we have Omega Healthcare, Healthcare Realty, as well as the others that we analysed on the 5-year total return. We have the average P to AFO as well as that of MPW, which sits below 4. Giving us an intrinsic value of $13.84, showing signs of severe undervaluation based on the market value. But as always, we're not looking at any of these models in isolation and we'll draw our conclusions towards the end. Now, the dividend discount model, we have the yearly dividends for Medical Properties Trust. Now, we can see that essential dividend cut last year. Forward looking, I have gone pretty much at 0%. You could argue, in fact, a dividend cut, so we should put negative. You could argue, in fact, we should put higher if we believe that it should be increasing next year. As always, click on that pinned comment below. You can grab a copy and put your own estimates and judgments. Based on it staying flat, we're looking at an intrinsic value of $7.50, giving some signs here of undervaluation. The final model, the DCF model, we have the free cash flows. Now, based on analyst estimates of negative 2%, with that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see here again another sign of undervaluation with the intrinsic value coming to $6.21. Now, the intrinsic value calculator is just the average of these three models that we've gone through today, coming to $9.18. Now, with the current price sitting at $4.21, although it has even gone lower, it continues to go lower as we can see, $3.98. It is picking back up from when we started. We can put the updated price in, and what we can see here is that with a margin of safety of 10%, which is what we start with and use if we believe it has a essential wide moat, strong financial metrics, good forward-looking data, it is a buy up to $8.26. Now, we can pretty much move this all the way down to 50%, and it is still a buy even at 55, and if we try at 60, it isn't just yet. So you are locking in, based on our estimates and judgments, around a 55% margin of safety. Now, to be honest, this isn't one that I'm personally looking to add to. So just because a company has a margin of safety of 55, 60, 70, 80%, it doesn't necessarily mean it is a buy now. You do need to consider a lot of different factors. The way the company is performing doesn't always get included within these models. And when we do look at Wall Street, they do also believe there to be upside of around 100% over the next 12 months. But as always, you shouldn't always focus your decisions on what Wall Street say. Always use your own thoughts, your own investment strategies, and your own due diligence and analysis. Personally, this isn't one I'm touching. I do see a dividend cut coming again, even though we saw one in 2013. They do have a significant amount of debt. Given the fact that they are finding some of their tenants to be unable to pay their rent, it is a cause of concern in my opinion. As always though, do let me know your thoughts in the comments below. Is this something you're happy with in terms of the price coming down so that you can add more? Or are you a shareholder and you're worried? Give us your bearish or bullish scenarios. Personally though, this isn't one I'm touching. And don't forget, click on that pinned comment below. You can grab a copy of the model, getting to the intrinsic value and acceptable buy price of companies in your own portfolio. And if you enjoyed the episode today, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop on your doorstep. As always, have a great day and catch you on the next episode. Bye-bye.